All right, today we're going to pull back the curtain on the number one secret that really determines if a crypto project is going to thrive or if it's going to die. And here's a hint, it has nothing to do with hype or complex tech. It's actually been hiding in plain sight this whole time. So, let's just get right into the big question. Why do so many of these projects just fail? I mean, we all know it feels like the Wild West out there. For every project that makes it, you hear about hundreds that just completely vanish, and they take a lot of people's money with them. What is really going on here? Well, the first thing that usually gets us is the hype. We see all the flashy marketing, right? The influencers, the crazy promises on social media about changing the world. It's exciting, for sure, but a lot of the time, it's really just a distraction from what's actually happening under the hood. Then you've got the other side of the coin. Some of us get totally lost trying to understand the super complex technology. We think, wow, this tech is brilliant, so the project must be a winner. But honestly, focusing only on the code can be another trap that really clouds your judgment. And of course, everyone loves to blame the market. A big crash happens, a bear market hits, and it's easy to just say, well, the market killed the project. And yeah, market swings definitely play a part, but they're very rarely the actual root cause of a project's total collapse. So if it's not the hype, and it's not just the tech, what is it? Well, it turns out the answer is right there at the very beginning. A project's fate, whether it's going to succeed or fail, is pretty much sealed the moment it launches. It's all decided by its foundation on day one. And that foundation, that's what we call token distribution. Now, I know that sounds kind of dry and technical, but stick with me. This is everything. It's basically the project's DNA. It tells you who holds the power, who's going to get rich, and whether the entire system is built for the long haul or just for a quick insider payday. See, when you boil it all down, every single project really follows one of two paths right from the start. And understanding the difference between these two is the key to, well, pretty much everything. Let's break them down. So on one hand, you have the fair path. Just think about how Bitcoin started. There was no pre-sale, no backroom deals with VCs. It was just an equal opportunity for anybody to get involved from the very beginning. It's all about community. But then you have the insider path, where private sales and big funding rounds give a tiny group of insiders this huge, often hidden advantage over everyone else. Now, this is what a healthy project can look like. See how it's balanced? Yeah, the team and the early investors get their piece of the pie, but look, a massive chunk. Half of it is set aside for the ecosystem and the public. This setup makes everyone want to work toward long-term growth, not just a fast payout. And then you get this, the imbalanced model. Just look at that. 70% of all the tokens are in the hands of insiders, and the public, they get this tiny little 10% sliver. A setup like this is basically a ticking time bomb. It gives those early investors every reason to just dump their tokens on the market as soon as they can, crashing the price for everybody else. Okay, so that's the theory. But how do you actually use this information? Well, let's get you set up with your own investigator's toolkit. It's a really simple checklist you can use to check out any project and spot those major red flags before it's too late. Here it is. It's just 4 steps. First, you've got to check who really controls the supply. Second, find out the vesting schedules. That's a fancy way of saying when are insiders allowed to sell. Third, look for whale concentration. And fourth, demand transparency. I mean, if a project is trying to hide this stuff, that's a huge red flag all on its own. Let's dig into that whale thing for a second. It's a huge deal. A project can't claim to be decentralized if just a few wallets hold most of the power. In a case like this, if the top 10 wallets control 65% of the supply, that means a handful of people can basically crash the price or control votes whenever they want. That is a massive, massive risk. So, if you're looking for a hard number to remember, here it is. If the team, the founders, and all the private investors combined hold more than 50% of the total tokens, you need to be really, really careful. That is a dangerous concentration of power. And this might just be the single biggest red flag you can find. A vesting cliff is just the time period when insiders are literally locked out from selling their tokens. So if that cliff is 0 days, that means they can sell all of their heavily discounted tokens on the very first day of trading. It's the classic setup for an insider dump that crushes all the public buyers. So the takeaway here is pretty simple. This isn't really about finding nice projects. It's about finding smart ones. Fairness in a launch isn't just some fluffy principle. It's an actual strategy for survival. A project that starts off fair is built to last. One that doesn't, well, it's often designed to fail right from the beginning. So we'll leave you with this question to think about. Now that you know the secret, now that you know a project's future is pretty much written in its launch, take a hard look at the projects you're invested in. Is your portfolio built on a solid foundation, or could it be sitting on a ticking time bomb?